Joining us is former Fed economist Catherine Mann. She also, I should say, served on the first President Bush's Council of Economic Advisors. She's now a Brandeis professor, and we love having you on as well, Catherine. Let me ask you about the same question. Hi there. Let me ask you the same question that I asked Brinjo earlier. With dissenters leaving this Fed one by one, is it too one-sided right now when you get the minutes? Can you see that?
The thing that I don't see in the minutes is a discussion of what they're going to do with the fact that the structural unemployment rate, by their own kind of work on it, is well north of 6. And so, and by their forecast or their predictions for the unemployment rate, it's going to be up in the 7s for another couple of years. That kind of unemployment rate is consistent with them going on with, QE4 or QE5. So they certainly can't do that. So I think there's a lot of inconsistency in what they say that they need to do, which is firming recovery, more jobs. They don't even predict that. And then a change in their monetary policy stance. So I think there's a real inconsistency with what they say that they are waiting for, which is job creation, before they'll change the monetary policy.
Catherine,
they've got to do it sooner than the unemployment rate would suggest.
Catherine, we've got 30 seconds before we have to take a break. So what does that inconsistency tell you? You've worked at the Fed. You're an economist. What does that tell you about maybe what internally is going on here? Just quickly before we take a break.
Well, they're going to have to give up on the unemployment target. Either that or they're going to have to give up on the inflation target. You don't get them both.
Is that going to shock the market if they do that?
Well, I guess the market gets to price in inflation into the interest rate.
All right, Catherine, Neil Grossman, he runs a hedge fund. He's come on with Matt and myself. He's emailing, and he says, Fed approach equals ostrich economics. Inconsistency equals instability. Is he right?
Well, I think the issue is that the governors and the FOMC really wants to see an unemployment rate well below 6. It's not going to happen. And so the problem is that they're going to continue to try to goose the economy using quantitative easing in an effort to get to that unemployment rate. It's not going to happen. Even by their own expectations, it's not going to happen. So the more they do that, the more they try to use liquidity as a strategy to promote equity increases, asset price increases, and consumption growth and that sort of thing. That's not translating. It hasn't translated into jobs. It's not going to translate into jobs going forward. So at some point in time, they're going to have to declare victory, meaning we're going to give up on trying to get the unemployment rate down and go home and start to return to a more neutral stance. Even 25 basis points, I'd be happy with that.
Can we have a healthy economy, in your view, without QE2 or QE3, et cetera?
Well, I don't think we can have a healthy economy with QE3. I don't think that QE2 had the impact on job creation and credit creation to the small and medium-sized enterprise sector as they hoped it would. It was a strategy to try to promote asset appreciation and equity, and through that strategy promote investment, promote consumption, and therefore get job creation going on. Well, it's promoted increase in equity price, but that's just translating into things like stock buybacks and mergers and acquisitions. It's not translating into investment in jobs that much. Consumption increases isn't doing it either. So the problem is that the capacity of monetary policy to lead to job creation requires a lot of channels of transmission, important ones of which are broken. And so we cannot continue to use that same tool to try to get to job creation. This is not a monetary policy strategy anymore.
What are you concerned about unintended consequences? I mean, we're seeing not only equity prices rise with no volume, so not a lot of push behind those purchases. We're also seeing, obviously, commodity inflation. We're seeing food inflation. Right. We see riots in the developing world.
These are all the unintended consequences of liquidity that is looking for something to do, job creation not being it. So it goes into asset prices, it goes into commodities, it goes into emerging markets that generates inflation there. And these are all of the unintended consequences of excessive liquidity creation. They're going to have to complete the QE2. Any dissension, any view that, oh, we're going to short circuit it or we're not going to do the $600 billion, that would have significant consequences for the bets made in the market today. But the notion that there would be more quantitative easing after they're done in June is really out of line, because giving the expectation that low interest rates will continue not for a foreseeable time, but until the end of time, until the end of their projection period in 2013, that's just crazy.
Hey, Catherine, 20 seconds left here. I can't remember, Matt, if it was Jeremy Siegel who was on, who said that maybe we'd actually start to see higher rates from the Fed, rate increases by maybe June of this year.
He thinks they should.
Is there anything on the horizon that you think from the Fed along those lines, just quickly?
Well, certainly the running off of QE2, no replacement of QE2 with QE3, that represents a relative tightening of monetary policy.
Okay.
So in June, when QE2 finishes, that represents monetary policy tightening, and that's what they will do.
Got it. Catherine, thank you.